SA 540 Auditing Accounting Estimates, including fair value accounting estimates and related disclosures. What do you mean by estimates? Whenever we don't have exact amount, we use approximates. That is called as estimates. What is accounting estimates? When we use estimates in financial statement items, it is called as accounting estimates. Why estimates are required? Because uncertainties are inherent in business activities. Example, market demand, useful life of machinery, productivity of labors. Because of specific characteristics of assets, liabilities, or component of equity. Example, valuation of unlisted shares, provision for litigation, unlisted shares, etc. Because of method of measurement prescribed by financial reporting framework. Example, Ind AS 113, fair value measurement, asks us to use assumptions from estimates for value of items which are not having market observable market. Overall responsibility of auditor. Auditor's responsibility is to evaluate judgments and its assumptions on the basis of current information available. It is not the responsibility of the auditor to predict new future conditions, transactions, or events which may occur in the future. Next, types of accounting estimates. First one, fair value accounting estimates. It includes fair value where there is estimation uncertainty. That means chances that actual outcome will be different from the estimated amount. Fair value means estimating market price at which asset will be sold or liability will be transferred using balance sheet sequences. Following are the examples. In respect of assets, regarding fixed assets, realizable value of fixed assets at the end of useful life, value of property, equipment held for disposal. Regarding investment, value of complex financial instruments not traded in active market or open market. Regarding liability, value of share options in share-based payments. Regarding common assets or liabilities acquired in business combination, value of assets or liabilities acquired in exchange of other assets or liabilities. Other accounting estimates. It includes estimates other than fair value accounting estimates where there is estimation uncertainty. Whenever we are estimating any amount other than market price of an asset or liability using balance sheet sequences, examples regarding assets, fixed assets, useful life of the asset, depreciation method for asset, regarding investments, for investments held to maturity, long term, provision for loss of value if there is uncertainty regarding recoverability, regarding current assets, provision for doubtful debts, provision for loss of inventory due to obsolescence. Next, regarding liability, provision for warranty obligations, provision for litigation, provision for losses arising from long term contracts. Next, step number one, risk assessment procedures and related activities for accounting estimates. Introduction. SA 315 tells us about what overall information and understanding should be obtained for a particular entity to identify risk of material misstatements. SA 540 tells us what understanding should be obtained to identify and assess risk for accounting estimates. Next, what are the overall information to be collected for all estimates? How management identifies transactions, events, and conditions, TEC, which gives rise for recognizing or disclosing new accounting estimates or revising existing accounting estimates. Auditor shall inquire of management about changes in circumstances that may give rise to new or revised existing accounting estimates, obtain list of accounting estimates and related disclosures, along with important requirements of applicable financial reporting framework. Specific information to understand how management calculate and determine accounting estimates, understand relevant internal control system, understand data used and its source, understand assumptions and their basis, which method or model is used for computing estimates, and whether there is any change from prior period method or model, whether management has used experts need to be checked. Special points regarding estimation uncertainty, whether and how management assessed estimation uncertainty. Review of prior period estimates. It is mandatory for auditor to review outcome of previous year accounting estimates or their subsequent re-estimation. Nature and extent depend upon the nature of accounting estimates and its relevance, that is connection with the current period accounting estimates. Review not intended to judge whether prior period estimates properly computed or not. Step number 2, identifying and assessing the risk of material misstatements. Auditor shall evaluate degree of estimation uncertainty associated with accounting estimates. If we identify high estimation uncertainty, then it is considered as area of significant risks. Then it is considered as area of significant risks. If we identify high estimation uncertainty, then it is considered as area of significant risks. Factors affecting estimation uncertainty. Hint is just old. J. Judgment as sensitivity. T. Techniques. O. Observable inputs. L. Length of forecast period and relevance of past data. D. Data reliability. First, judgment. Extent to which estimation depends upon the judgment. S. Sensitivity. Sensitivity to changes in assumptions. T. Techniques. Existence of measurement of recognized techniques and subjectivity of assumptions used as inputs. O. Observable inputs. Whether inputs are observable or non-observable. L. Length of forecast period and relevance of past data. Length of forecast period and relevance of data drawn from past events. D. Data reliability. Availability of reliable data from external sources. Higher the degree of estimation uncertainty, more are the chances that management may use this particular area for manipulation. That means it is susceptible to management bias. Next, high estimation uncertainty examples. Hint is DFL. D. Derivative financial instruments valuation, which are not publicly traded. F. Fair value accounting estimates, for which highly specialized entity developed model used of which assumptions and inputs are not observable. L. Litigation outcome related to accounting estimates. Low estimation uncertainty examples. Hint is FMCG report. F. Frequently made and updated because they relate to routine transactions. M. Method of measurement prescribed by applicable financial reporting framework is simple and easily applicable for asset and liability. C. Complexity involved in business activities is extremely low. G. Generally accepted or well-known model is used for fair valuation and assumptions or inputs are observable or readily available data is used to derive accounting estimates, that is observable data. Next, step number 3, response to assessed risks of material misstatements. Auditor responsibility. Method. Check whether method is appropriate, whether consistently followed, if there are changes, whether changes are appropriate in the circumstances. Applicable financial reporting framework. Check whether relevant requirements are fulfilled. Audit procedures to achieve above responsibility. One or more of the following procedures should be applied. Testing effectiveness of controls, appropriate substantive procedures. This is the common method. Examine reliability of data, check reasonableness of assumptions, appropriateness of method, whether management has computed or determined appropriate accounting estimates, recalculation, recomputation. Point estimate, that is single value, and range estimate, minimum or maximum value. This is the special method. In this, auditor computes point estimates or range estimate using set of assumptions and methods which are different from the management, and then evaluate whether there is significant difference from the management estimates. Auditor should understand management assumptions and method to ensure that he has taken all relevant variables while making calculations. For range estimate, if range estimate is used, auditor should ensure that range should be sufficiently narrow such that estimates which comes within this range is considered reasonable. Subsequent events. Check whether there are events after balance sheet date and which provide additional information for accounting estimate. Next, step number 4, disclosure related to accounting estimates. For all accounting estimates, auditor has to check whether the disclosure of accounting estimates are as per requirement of applicable financial reporting framework. If there is significant risks in accounting estimates, auditors should additionally evaluate adequacy of disclosures with respect to estimation uncertainty. Further explanation. For, for, for all accounting estimates, financial reporting framework focus on material items and generally requires following disclosures: assumptions used, method used, basis of selecting methods, changes in methods, source of estimation uncertainty and its implications. If there is a significant risk in this, even if all the requirements of financial reporting framework are followed, still auditor may conclude that disclosures are inadequate and ask management for more disclosures and go beyond financial reporting framework. Step number 5, written representations. It is mandatory to obtain written representations from the management and those charged with the governance. Ensure that all points related to assumptions are covered. Depending upon estimation uncertainty, include more things connecting with earlier steps for ease and retention. Step number 1, specific estimate related points. Step number 3, subsequent events. Step number 4, disclosure related points. Basis and appropriateness. Estimates not recorded are disclosed. Fair value presumption not followed. Review of prior period estimates. Mandatory to review outcome of estimates and re-estimation. Benefits of reviewing prior period estimates. Hint is bear. B. Whether management is biased. E. Effectiveness of estimation process. E. Degree of estimation uncertainty involved. R. Re-estimation. Audit evidence for re-estimation. Review of prior period estimates should be checked whether they are with objective or not objective to find out misstatements in prior periods. Step number 6, documentation. What are the things that need to be documented? Basis for account auditor's conclusion. Basis for auditor's conclusion for reasonableness of estimate and disclosure that give rise to significant risk and indicators of management bias, if any, should be documented.